Buckle up, everyone. You are strapped in and ready for the Insurance Hour with me, your host, Karl Susman, informing, educating, and entertaining Californians one policy at a time. This is Insurance Hour. Hello. This is Insurance Hour. I am your host, Karl Susman. Thank you so much for being here today. We have a very special guest. Let me introduce her in just a moment. Meanwhile, do know that the phone lines are open. You can call us at 559-656-0317. You can also text that number. You can send your questions in to questions@insurancehour.com. And of course, to add to our text list, go ahead and shoot us a text saying anything, but be nice, to 567-4-KARL. It's 567-367-5275. Without any further ado, let me introduce our special guest today. This is Amy Bach. She is the Executive Director of United Policyholders. She has been a professional insurance consumer advocate since 1985, when we were all in diapers, right? She co-founded United Policyholders in 1991, serves as the organization's executive director and primary spokesperson, shaping and overseeing the roadmap to recovery, roadmap to preparedness, and advocacy and action programs. She is as involved in the insurance world as can possibly be. Amy, welcome, and thank you so much for being here today.
It's a pleasure to be with you, Karl.
There is no shortage of insurance news, as always, so I want to just jump right into it with you. I want to talk primarily about what consumers are feeling and seeing the most. And I know that you are right in the thick of this. You're the one that's getting these phone calls. You're the one that has these meetings. You are the one in the middle of it all. So let's start out. Tell us, where are we today in California with the insurance marketplace?
We are in an unprecedented period of time, from people like me who've been in this sphere for three decades or more, agents who've been selling insurance their whole careers. Everybody uses the same word. Never seen anything like this. It's unprecedented.
So there are lots of blame to be going around, right? Everybody blames somebody else, and nobody blames. I shouldn't say that. Everybody blames somebody, right? It has to be somebody's fault that we're in this position. And a lot of times we're hearing different people being blamed. Do you have any particular one, this is the reason we're in this situation, or is it much more nuanced than that? Tell us a little bit about this so people can feel more educated and not just hearing the 30-second sound bites about who created this mess.
Yeah, there's no one person to blame for this, in my opinion. It's really an unfortunate kind of perfect storm of a lot of different phenomena happening simultaneously. But then the underlying issue for me as a consumer advocate is that this is the first time that I can say, and I've been a consumer advocate for many, many years, that there's a lot of question whether this private insurance system as we've known it is really going to continue to be viable in an era where climate change is a reality, but technology has really rushed in to make the risks that insurers were taking for as long as we can remember look unprofitable to them, to a degree where it's really unclear to me whether we're going to be able to return to the competitive, affordable property insurance market as we knew it. And so really what that kind of leads me to think is, like, we have said over the years, I'm a lawyer, and, there have been cases that talk about insurers as quasi fiduciaries, or, that they're a little bit like a utility, right? But we don't treat them that way. We regulate them for sure.
If I can just put a pin in that, can you explain what a fiduciary is and what that means, being a utility? I understand, but I want everyone to be on the same page with us.
Right. So it's a fiduciary is, I'm legally obligated to look out for your financial interests as well as my own. So, like, there are cases that say an insurance company has to put its financial interests on a level with the interests of its customers. They can't put their own financial interests above. Now, that has to do with paying claims. That is in the context of somebody has had a loss, they make a claim, they want the insurer to pay, and when the court is looking at did the insurer uphold their obligations or not, they're going to look at that concept. In this context, what I'm talking about is really more a utility has to serve everyone. A utility, the power company, they can't say, "Oh, I'm not going to provide you with electricity. I don't like you." They have to give you electricity as long as you pay what they're charging, right? We don't have that with insurers, right? We have relied on competition to serve all customers, and it's not working anymore. And I, as much as we may try to fix things so that it works again, I have some deep concerns over whether we'll be able to really look to private insurance companies as we have to serve everyone, because they're basically are saying, "Hey, we can't do that."
So right now we're seeing a situation where it's next to impossible to get an insurance proposal or policy from insurance companies. And we're talking specifically in California. But what are we seeing countrywide as far as this level of carriers not having the ability, appetite, desire, call it whatever you want, to be writing policies?
Karl, it's a virus that is spreading across the United States. Florida got it first. Then we got it. Now Colorado's getting it. But when I go to the conferences of the National Association of Insurance Commissioners, and I sit in on meetings and I have conversations with regulators, Iowa, Pennsylvania, Georgia, I can't even think of a state that hasn't said our market just doesn't look like it did in the past. The people are getting dropped. The carriers are pulling back on their underwriting. And that's why I believe it isn't just climate change. It isn't just wildfires. It isn't just hurricanes. It's something deeper.
So what I want to do is I want to talk a little bit about what you see as being more of the larger picture. What are some of these other factors? I know technology is one of them. So we're going to take a quick break. When we come back, let's talk a little bit about, again, how this is affecting everybody everywhere. I like the virus analogy, although it's a horrible way to put it, but it is certainly apropos to the way we're seeing this. And I think it's also important that everybody realizes that this is not just a California thing. Everybody loves California, right? But this is not something that we created, and it's not something that we're the only ones suffering from. So let's take a quick break. When we come back, we'll talk a little bit more about that. Again, this is Insurance Hour. I am Karl Susman with our special guest from United Policyholders, Amy Bach. We will be back in a flash. Hang in there. Let's talk about earthquakes for a minute. Look, we know we live in earthquake country here in California. Powerful, devastating earthquakes have happened here before, and science says that they will happen again. They can't tell us exactly when. They can just tell us that it is going to happen. Count on it. Prepare for it. Did you know that earthquakes are not covered by your homeowner's insurance policy? You need a separate policy to give you the peace of mind that you will be able to recover without getting financially wiped out the next time we get hit with a big one. There's a great company here in California that will provide you with earthquake coverage you need at a price you can afford. That company is GeoVera. I have a policy through GeoVera. I really like how easy it is to choose from all of their great coverage options, backed by the financial strength that lets me know that they will be here for me when I need them the most. Go to getquake.com/insurance hour to learn more. That's getquake.com/insurance hour. Make sure you're ready for the day when the ground shakes again. Hello. This is Insurance Hour. I am your host, Karl Susman. Thank you so much for being here. Remember, the phone lines are still open, 559-656-0317. You can call us or text at that number or email your questions in to questions@insurancehour.com. Join our text list. You can send a text of any kind to 567-4KARL. That's 567-367-5275. We are here with our special guest from United Policyholders, Amy Bach. Amy, thank you again for being here. Before the break, we were talking about how California is not on its own little island here with the issues facing insurance carriers and availability. Tell us a little bit about how you see this having started, continued, spread, and what we might be looking to have happen in the near future.
So I think that when we look at when we started seeing non-renewals, just in California, patterns of people getting dropped by their insurers and not being able to find a competitor, right? Because that's sort of the new, that's the unprecedented part, right? Unprecedented part is like in the past, we've always had these periods in California where insurers' appetites were not as hardy for for insuring homes in certain areas, especially after wildfires, right? But competition always filled the void, right? One carrier would drop a household, and then that household would be able to get coverage through a competitor, right? When that stopped happening, we initially thought, this is definitely climate change. This is insurance executives, C-suite executives going, wow, we better get ahead of this thing. This is going to cost us some money. And then we had a series of horrible record-breaking wildfires, right? Right after it was revealed that there were 120 million dead trees along the spine of the Sierras, which scientists attribute to climate change-induced drought, making it harder for the trees to fight off these invasive beetles. That was the climate change news item, right? That seemed to trigger the non-renewals. And then suddenly, then we had in succession, Atlas Tubbs fires in Santa Rosa, affluent, high value homes went down, regular value homes went down, 7,000 structures, record breaking, followed by the Camp Fire, 18,000 structures, again, breaking another record. Thomas Fire in Ventura, and then Woolsey, Malibu, my God, big whopper bills that came into the insurers from those areas. So that compounded. And then we had the advent of risk scoring, that just like you can see, what your credit score has an outsized impact on the interest rates that you'll be offered, on whether you'll be offered a credit card or not, what kind of interest rate you'll be offered, and what kind of loan terms you can get. Credit score, very, very important. Now, insurance score, very, very important. Then we had the manned drones phenomenon of aerial images and data mining, and all of these are the factors that have come together to bring us to where we are now, and to interfere with the normal forces of competition. And on top of that, Karl, as you know, insurers have never lived on premiums alone, right? They take the premiums that they collect, they invest them. And when the stock market is good and they're making good returns on their investments, then life is good for them. Over the last few years, we have had a lot of fluctuations in the stock market. We've had inflation, we've had investor jitters, and all of that, I think, is also in the mix here to reduce insurers' appetites for insuring, and not just homes, but businesses. I mean, I sit down with agents that insure wineries, and they cannot find coverage. And they're flying.
I thought you were going to say they can't find the front door because, they're insuring wineries and they're not sure where they are. But yours is a better way of putting it.
I mean, and that's those, every time I would hear something like that, it would be another alarm going off, like, what? First we thought, okay, climate change, we'll deal with that. They can charge more, right? And people will understand that, right? But then it's going to be a question of how much more. But then it was like, well, it's not that simple.
Your organization does a lot to help consumers, and they reach out to you for questions and for advice and for help. Tell us, what are those types of calls and reach outs for assistance looking like these days?
Well, for one thing, the premium quotes people are getting are just jaw-dropping. I mean, I had said years ago, the days of paying under $1,000 a year for your home insurances are over. Like, we got to move past that. We're not talking about $1,000 going up to $2,000. We're talking about $1,000 going up to $6,000 or $10,000, depending on where you live. So so the number one complaint, of course, is I can't afford this. I don't know what to do here. And then the number two is my only choice seems to be the fair plan, and I hear this and I hear that. So like we're quelling rumors about the fair plan, like they're going to run out of money. I don't think that they're going to run out of money. I mean, not anytime soon. There's a legitimate concern about it, but it's not a reason not to buy a policy through them, right? So those are the two. And then the third most common is I did the things that the insurance company asked me to do, and I still got dropped and I still can't get coverage. So where's the fairness in that?
Those are all great points. And I know we've talked about that in the past as well. As far as those rates going up, do you find that most people are seeing those rate changes from the same company, or is it they were paying one premium with one company, they were non-renewed, and all they could find was something that was, again, from 1,000 or 2 to 6, 8, or 10,000?
Well, we look for good news wherever we can find it. And so, there definitely are some of the traditional brand names where they are renewing, and it's not, a triple, it's maybe a double of the premium. As far as though the new entrants, the bamboos, the kins, the Northlight, all over the map in terms of pricing.
All right. I want to talk a little bit more about what some of the advice is that you're giving to people when they reach out to you. We're going to take another quick break. And also, I want to make sure everyone knows we will definitely talk about the California Fair Plan. I promise. I know that is on a lot of people's minds and their financial solvency and everything surrounding that. So I don't want people to think that you mentioned it and we're going to just pretend it wasn't said. We're definitely going to talk about the California Fair Plan. So let's take another quick break. And when we come back, we'll continue the conversation with Amy Bach. This is, again, Insurance Hour. I'm your host, Karl Susman. We'll take a quick break. And when we come back, we will be here to answer more questions for you. Thanks.
Ladies and gentlemen, boys and girls, in just a few moments, the Window to the Magic podcast show will begin.
My name is Patrick.
My name is Calvin.
I'm Mouseketeer Gray.
My name is Paul, and I will be your guide through the wonderful world of Disney sound experiences. This show is a weekly trip into the world of the Disney theme parks and resorts. And this is the place where you get to use your ears to surround yourself with the magic.
For your safety, please remain seated while listening to the windowtothemagic.com podcast.
Maybe there's a name for this, something like Disnotic obsession. Please visit windowtothemagic.com for more information, or you can find us on Apple Podcasts and in the iHeartMedia app.
Hello. This is Insurance Hour, and I'm your host, Karl Susman. Thank you so much for being here. If you've missed any of this show so far, jump online and look us up because you want to get all this information. We have special guest Amy Bach, but I want to, again, be sure you realize that what you're hearing now is just a sample. If you've missed any, jump online, search for Insurance Hour. You can find us on YouTube, Apple Podcasts, iHeartMedia, pretty much everywhere. Again, the phone lines are open if you have questions for myself or for Amy. 559-656-0317. You can call or text that number. To get on our text list for important insurance updates, go ahead and shoot us a text to 567-4KARL. It's FORKARL. 567-367-5275. Okay, before the break, Amy and I were talking about questions that she gets from consumers that are having issues with insurance. Amy, you gave us 3 examples of the common questions you get. What type of advice are you giving people? Let's start with the first one. What are you telling them when they're saying, I was paying $2,000 and now either the only carrier that wants to take me wants to charge $8,000 or the carrier that I have doubled in price? So
we give some of the traditional tips, which are bundle your car with your home, and that may help. Raise your deductible. That's a big one. Don't file small claims. Find a really good agent or broker. That's kind of elevated. We went right up to the top of our list because in this tough market, it who you know is always going to be a rule in our world. But working with an agent or broker that has that is proactive in this challenging market, that isn't drowning their sorrows in the local tavern, or just telling you, going to put you with the fair plan, like right out of the box without really shopping. That's not the kind of person you want. Like, you want somebody that's going to really beat the bushes for you and may have these relationships with some of the newer companies that you might want to go with. So raise your deductible, bundle, work with a professional, and then this is the hardest one: trim non-essential coverages as a last resort. Right now, here's my organization has spent 30 years trying to prevent people from having being underinsured on their dwelling. So we've had to really shift our messaging, right? We would always harp on, in our preparedness presentations and our publications and our answers to consumers, make sure you get that coverage A right, get your dwelling number right? So that you're not in that 2/3 of people who lose a home in a wildfire and find they didn't have enough coverage to put their house back. We can't really even talk about that much right now. I mean, we will mention it. We will say it's still important to try to get that number right. But we recognize that for a lot of households now, they don't have that luxury of having the full coverage. They've got to trim. So where can you trim? Contents. Stuff is stuff. A lot of policies, give you more contents coverage than you really need. Other structures, we say if you don't have outbuildings and garages, see if you can stop paying for that. Now so those are kind of the two places where people can trim, where we feel like it won't hurt you too much if you have a claim. Now, you're not only are you an expert in this field and one of our very important sources of information from the field. A lot of policies have these automatic percentages. So there's some carriers, they won't let you reduce other structures or reduce contents below a certain amount because it's just that's their formula. But those are the main points that we give people to try to bring the policy down. We whenever people say, I've been told the fair plan is my only option, we always try to remind them that talk to one other agent, because it is possible that agent didn't want to lose your business and that was the only option they could find for you. And so rather than send you down the street to somebody else who might be able to help you, they just put you in the fair plan. That would be your captive agent. That would be your farmer's agent, your State Farm, your Allstate. They don't want to lose you. They don't have anything to sell you other than the fair plan, so they might throw you in there. So we try to encourage consumers to at least talk to at least two people. I know that probably hurts you as an agent, maybe to hear. But you're not one of those agents. You're not going to throw somebody in the fair plan because you don't have an option. If you put somebody in the fair plan, it's because you did that diligent search and there was nothing else for them.
Independent agents definitely are finding their footing, because agencies, again, like you said, like ours, it's all about reaching out to every carrier that we possibly can find and see what are they taking, what is their appetite, who can we fit there that is looking to get coverage. But you're right. Not all agencies have that option, either contractually or simply just because their business isn't designed that way. Because a lot of these carriers now, they're being very particular and they want to be sure that they're getting a particular type of business. So there's a lot of trust that goes into that. Your second point was what to do if people are actually doing this work and then they're still not getting renewed. What are you telling people under those circumstances?
So we are dialoguing with insurers as much as we can to try to help them gain confidence that if somebody has taken steps to make it less likely that their home's going to burn, even if they haven't done every single thing on the IBHS or the Safer from Wildfires list. Those are the two official standards for what you can do to make it less likely that your home is going to burn. We've been dialoguing with insurers to say, hey, you should recognize these things, by and we are getting a little. I mean, that's sort of the Department of Insurance would call that like the bully pulpit. We don't have the bully pulpit even. We have the do this because we'll praise you publicly, and that will make you look good in the media, and that will help, clear your black eye that you have. Look, we United Policyholders helped get those standards into place. We pushed for the regulations that require insurers to give you a break. If you do mitigation, we are working very hard to help build those channels of information on completed mitigation so that insurers actually know what people are doing, not just in their individual homes, but in their communities. And all these things are sort of a work in progress, right? But again, an agent like you who actually knows how to fill out the paperwork to help your clients get those discounts, again, that's just so valuable. And, that's another thing we tell people is, look, give your insurance company invoices, give them completed proof. But we know, that in the real world where we live, insurers are still skeptical about incremental risk reduction steps. They want to see you waive that certificate. I got this piece of paper from the Institute for Home and Business Safety that says I'm a wildfire prepared home. That's the shortcut to getting your discount. It's much harder to get that piece of paper than we would like it.
Then just send it, and especially it's a lot harder than just sending in a receipt. Let's take a quick break. When we come back, we'll talk about the third thing that you keep hearing from everybody and what your recommendation is for them as well. Again, Insurance Hour, and I am Karl Susman with special guest Amy Bach.
Have you been dropped by your insurance agency or seen your premiums skyrocket? Susman Insurance is here to help. We're a family-owned and operated insurance agency that's been serving our community for 2 generations. At Susman Insurance, we know how stressful it can be to find the right coverage, especially when prices go up or you're left without insurance. That's why we're committed to finding you competitive rates, whether it's for fire, home, earthquake, flood, auto insurance, you name it. We've got you covered. Give us a call or send a text to 310-820-5200 or visit us online at sussmaninsurance.com. Plus, stay updated on all things insurance by joining our text group. Just text 567-4CARL with a K. That's 567-367-5275 to get the latest updates straight to your phone. Susman Insurance, your family's insurance solution.
Hello. This is Insurance Hour. I am your host, Karl Susman. Welcome back. Today with our special guest from United Policyholders, this is Amy Bach. We have been chatting about all things insurance. I know your favorite thing in mind. Remember, if you've missed any part of the show, lots of important information here. Jump online, search for Insurance Hour. It's on YouTube. It's on Apple Podcasts. It's on iHeartMedia, TuneIn, you name it. Just find us and find this episode because there's a lot of good information that will help you with your insurance. Amy, before the break, we were talking about the top 3 things that you're asked as a consumer advocate, and we're down to the final one. And I believe it's one that we were going to talk about in some detail as well. Why don't you go ahead and get us started on that?
So the FAIR plan. People ask us, what is it safe? What is it? And, is it a government program? Is it, are they, going to run out of money? What is it a one size fits all? And what's the story with this thing? Right. And some of these questions are familiar because we were around when the California Earthquake Authority was formed. And there were a lot of similar questions at that time when we had the Northridge earthquake and insurers kind of en masse said, we don't want to cover earthquake damage anymore. And so the state stepped in and created this plan. Well, the FAIR plan is similar. It's not the same, but it's got some similarities. We tell insurers, if you want to do business in this state, you want to sell insurance at all, if you are a certain kind of insurer, you must participate in the FAIR plan. But it is a private association. It is a, and what the insurers will call it, an involuntary association is what they call it, right? And it is so it's run by private insurers. It's administered by private insurers. Really, the state has very limited, a very limited role in how it works. So when the CEA was first formed, the Earthquake Authority, one of the first questions people had is, if I buy insurance through this entity, how can I be sure that if there's a big disaster, I'm going to get, and I am impacted, my claim's going to get paid. So that first question of the financial strength of the FAIR plan is right there in front of people, top of mind.
I think what I want to touch on some more, because I know it always raises eyebrows when I say what you've just said, which is the FAIR plan is run by insurance companies.
Right.
Can you give us a little bit more on how that works and how they're, you call it the involuntary association, or how does that actually work in practice?
So the FAIR plan is an association of all the admitted, that means fully licensed, fully regulated insurance companies in the state. So it's as a condition for doing business here, you must participate. And your participation means that you have to share in the assets and liabilities of the association. So in a percentage that matches your market share. So if I'm State Farm and I have a fifth of the market share in the state, I've got a big role in the FAIR plan. So I, not just in terms of servicing policies, sending out the bills, keeping the accounts, but if a claim comes in, the liabilities right now are covered by all the participating insurers, again, relating to their market share. The tricky part there's a lot of tricky parts here. One is we've got to have admitted insurers participating in the FAIR plan, right? In order for there to be a FAIR plan. It's their money in the pot. It's your money, the premiums you paid go into the FAIR plan, but then they manage that money, just like a regular insurance company, right? But it's a team effort. Governing board, I don't even know who's on it. It's opaque. They're not subject to open meetings laws, so we don't know a lot about their operations. They are run by Victoria Roach, but really we the public don't know a whole lot other than this market share formula for the participation. And if they run out of money, the old rule was that all the participating insurers would have to kick in, they would get assessed for the shortfall. Let's say there's a huge wildfire and the FAIR plan has, let's say, 5,000 claims that come in at once. Something like
I just got the chills, even talking about it, but okay, go ahead.
And if they didn't have enough money to pay all those claims, under the old rule, every insurer that participates would have had to kick in to cover that shortfall, right? And again, it would be this, well, I've got a fifth, so I got to kick in a fifth, right? Basically.
A fifth after the FAIR plan ran out of funds.
After the FAIR plan ran out of funds. Now, new rule that Insurance Commissioner Lara negotiated recently with the FAIR plan. It's kind of a big deal. It hasn't really gotten a lot of publicity. Now, instead of all those private participating insurers being on the hook for the full amount of that shortfall after the FAIR plan has paid out everything that it has in reserves, is going to be 50-50. The insurers carry 50, and we, the policyholders, are going to carry 50. Now, lest you got the chills, your viewers, your listeners, this is a very what if, right? This is just what if. This is not like so it's really, a question of where you fall on the optimism or pessimism spectrum. Is this a looming crisis? What would this mean for us as policyholders to pay 50% of the assessments if the FAIR plan doesn't have enough money to meet their obligations after a big cat? Very much a what if scenario, and I do not know the answer to that question.
So if I'm getting the sliver of potential, it's if there's a large enough event that the FAIR plan first runs out of money, second has to assess all of the insurance carriers based on their market share, and then of that assessment, if there's one, they're allowed to then pass on half of what their individual assessment as a carrier was to policyholders of the FAIR Plan or policyholders of their policies that are not FAIR Plan?
All policyholders.
All policyholders.
All policyholders, yeah. So, I mean, we're really in the weeds here, Carl. You know, I that's a problem because we work together. We're, you know, both of us are super wonks here. For the regular person, they don't need to be worrying about that right now, in my opinion.
I agree. That's why I'm saying I'm trying to see it's such a small sliver. This is not something that's really even anticipated, to be frank. But it's like you said, it is kind of a big deal that it happened. Let's take another quick break, and I want to talk some more about the FAIR Plan, and let's get a little into the weeds on the finances because I have their latest numbers handy. Insurance Hour, your host, me, Karl Susman, and special guest, Amy Bach.
Ladies and gentlemen, boys and girls, in just a few moments, the Window to the Magic podcast show will begin.
My name is Patrick.
My name is Calvin.
I'm Mouseketeer Gray.
My name is Paul, and I will be your guide through the wonderful world of Disney sound experiences. This show is a weekly trip into the world of the Disney theme parks and resorts. And this is the place where you get to use your ears to surround yourself with the magic.
For your safety, please remain seated while listening to the windowtothemagic.com podcast.
Maybe there's a name for this, something like Disnotic obsession. Please visit windowtothemagic.com for more information, or you can find us on Apple Podcasts and in the iHeartMedia app.
Hello. This is Insurance Hour. I'm your host, Karl Susman. Thank you so much for being here. We are with our special guest, Amy Bach from United Policyholders. Some amazing information you do not want to miss. Make sure you stay with us now. And if you've missed any of this, jump online, search for Insurance Hour, grab this episode because there is a ton of important information here. Phone lines are open, 559-656-0317. Call or text that number. You can email your questions in anytime to questions@insurancehour.com. And of course, join our text group if you want to get important insurance-related updates. Send us a text to 567-4-CARL. It's 567-367-5275. All right, Amy, we're into the FAIR Plan weeds now, no pun intended. And the big question people have is, do they have money and will they be there? And I think we'll answer that question as best we can, but I think it's important we point this out. The FAIR Plan, so an insurance carrier looks at a home and says, no, I don't want to write that because it's too high of a brush risk. So they go to the FAIR Plan, but the insurance carriers are actually going to be paying for that risk based on their market share anyway. So whether they're getting a policy from a carrier or from the FAIR Plan, at the end of the day, the money is coming to some extent from the insurance carriers. Is that a fair way to represent it?
Yes, absolutely. The FAIR Plan is as financially strong as all the participating insurers in the program.
Okay, that's right. And so the latest numbers that I have show that the current exposure, meaning if every policy that the entire FAIR Plan has had a total loss, so every policy on their entire book had a loss, they would have about $280 billion in total exposures. And right now, currently, in their coffers, in their reserves, in their bank, they have about $2.8 billion. So people look at that and, of course, they panic. They say, well, that's a big shortfall. So explain why that's not, that the numbers don't really speak to the reality based on what's being written with FAIR Plan and the money and the carriers that are backing them.
Well, the most important reason is that not everybody's going to lose their homes at once. I mean, even the worst, conflagration that we've had in this state, the Camp Fire, I mean, the most number of homes that went down was 18,000, right? So that's number one. You're not going to see everybody making a claim at once. Number two is you're not going to see people ever making total loss claims either, right? So, and there's a lot that the FAIR Plan doesn't cover, right? They don't cover water, they don't cover wind. So, that's just not a scenario that's going to play out, that every single insured would make a claim at the same time. There's also the reality that we actually are getting much better at preventing big conflagrations here. Like the fires that just were just hit down in SoCal, one of them stopped at of what's called a fire break, which is an area that the fire department has cleared of a public on like, forested land. That kind of strategy is working. We're putting so much more money into fire suppression, early resources, helicopters, and risk reduction. So I never want to be, I'm not Alfred E. Newman here saying what me worry, right?
Oh, you're aging us with that reference.
Yeah, I know.
Alfred E. Newman.
I know, God. Oh my God, man.
If you know who that is, please send me an email so Amy and I don't feel so bad.
Sorry. Anyway, my point is like, I can't make light of this. This is people's homes are their biggest assets. And also, we're not just talking about homes, we're talking about businesses. So I never want to be cavalier about the possibility that somebody's going to lose everything and come up short, right? Not have a safety net, right? So, it's a doomsday scenario that's not going to come to pass.
I understand. I think that it's important that everyone realizes that these exposures have always existed. We've just never talked about them.
Right.
And now because everyone is so involved and you'll get a headline, you'll see something and you think, oh my gosh, and then you stop thinking about it. And then there'll be another headline and oh my gosh, and you stop thinking about it. At the end of the day, the Department of Insurance is around, their primary focus, I could probably say, is to be sure that there are dollars around to pay for claims in some form or another when they happen. And if I take that global view on it, should people be concerned?
Yes, I think, and you probably are not going to like this answer, but because of where we started in this conversation, we don't treat insurance companies like utilities. We treat them like, not entirely like free market capitalist actors. But we, by and large, they definitely get to pick and choose which customers they're going to serve. And if we're going to keep that going, and then we do have the commissioner's deal that that now that insurers in California are allowed to use these catastrophe models in setting their rates and instead of the way we had been doing it, which is only basing their rates on historical facts of what actually happened. Now that insurers have gotten that, which they were lobbying for many years, they are in turn have committed to write more homes in these distressed areas. Short of that, we're still not telling insurers that they have to sell insurance to anybody they don't want to. And with that said, it feels like we're leaving ourselves no option but to create a new publicly supported disaster, insurance program. It feels like if we don't want to tell insurers they must take all comers, which is what we did with the Affordable Care Act, right? Somebody's got a medical condition. It's not an if they're going to have a claim. It's a when, right? We told health insurers, sorry, you're going to have to adjust your business model to provide some coverage for those people, even though they're going to make a claim. We either go that route with property insurance and we say to insurers, you're going to have to take some of the bad with the good, which is what the FAIR Plan is. That's exactly what it is, right? You have to take a little of the risks you don't want with the ones you do in order to write the ones you do. If we can keep that formula going, then we may not need